Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hello, welcome back to the Investing Podcast presented by Tusk Media. My name is Ben Nye, and today I want to talk a little bit about Cousins, which is a real estate investment company, and also Del Frisco's, which owns a number of restaurants. They own steakhouses, they own upscale grills, and they also own, Sullivan's is also a steakhouse. So we're going to talk about those two companies and some news that they've had over the last few days and what that means for them going forward. So jumping right into it, Cousins is a REIT that spun off, that merged with another entity called Parkway, and they basically moved all the good assets into Cousins and all the bad assets they moved to Parkway. Now Parkway, when I say bad assets, I'm talking about things that are exposed to the oil and gas business. So when you're talking about Parkway now, you're talking a lot about the Houston exposure, and you have to be making a call almost on oil and gas because that determines whether the credit worthiness of the people who are actually using office space in Parkway offices. Now Cousins is located principally in the Sun Belt. So they have large positions in Atlanta, for instance, which is where we're located. And those are areas that are growing more rapidly. The assets are generally located in the expensive, the prime real estate space. And Cousins just announced their dividend. There's some concern about where would the dividend end up being for Cousins because it's a new entity and it was difficult to model for people to know exactly what asset was going where. They came out and said that we're going to do 6 cents per share in dividends per quarter, which is 24 cents annualized. My estimation is that they left some room for that to increase in the coming quarters and coming years, and I think you could see that increase to 7 or 8 cents not too distant future. Maybe it'll take a year, but I think you'll probably see some decent dividend improvements there. So if you say 24 cents per share in dividends, now people can start to put numbers on the stock. Look at BXP Boston Properties. Dividend yield is about between 2.25% to 2.5%. So you think about Cousins now, which is arguably in superior territory, faster growing territory, maybe not the durability of Boston Properties, but still in a faster growth area. And you think, well, maybe they can be about 2.5%, maybe 2.6%, and all of a sudden you're thinking about a stock price that's more like $9.50, $10 per share, rather than the current $8.30. So we are long Cousins. We've owned it for quite a while. We actually owned it prior to the spinoff, and we're continuing to hold here because we think it's undervalued. Obviously, the rising interest rates will affect the relative attractiveness of the dividend yield. Nevertheless, I think the growth that we should see in real estate prices in the areas, especially in Atlanta, should help Cousins' stock value appreciate and kind of get down to that 2.6, 2.5% dividend yield in the not too distant future. So we like Cousins. Second company that I wanted to touch base on was Del Frisco's. There's been a wide variety of reports in the restaurant industry. Some are positive, some are terribly negative. So it's really important to actually know the company that you're dealing with, know the management team. And that was one concern for Del Frisco's because they lost one of their CFO in December. They replaced him. So that was a concern. But Del Frisco's came out with upbeat guidance and importantly, traffic improved sequentially from Q3. Now it's always important with these companies to really say, well, can we believe management? Can we trust what they say? And at Del Frisco's, it's important and notable that they are doing what they said they were going to do. So even if that's bad, if that's good, You just want to know that management can be relied upon. So when they say that the industry is bottoming, that their company is bottoming and starting to work their way out of it, they can actually trust them and start to put two and two together. So in the case of Del Frisco's and in the Q3 conference call, they did talk about how restaurant traffic was subdued, in part because of the election. They said they've been in this industry for a long time, and that people just hold out on going out to eat prior to an election because they're watching debates. There's a degree of uncertainty. You're not thinking about going out to eat when you're thinking about who's going to win the presidency. So now some companies also were talking about that, and they've since said, we thought we were going to get an uptick after the election. We did not. Not the case in Del Frisco's. If we look at the same-store sales, it's an attractive chart. If you look at all three restaurant concepts were up in the fourth quarter. This was the first time that happened since the second quarter of 2015, first quarter of 2015, right in there. So it's been a long time coming for Del Frisco's. Now, it means it is going against an easier comp. So bear that in mind, but it's important that same-store sales are up. Concept by concept, the Double Eagle is the biggest profit driver for the company. Traffic was improved. Same at the Grill. In fact, for the Grill, it's the first time the traffic was up. And same-store sales were up nicely. And that's a new concept for them. And it's good to see that that's paying dividends. Sullivan's is an older concept. It's not a very meaningful profit driver for the company. But even in that case, you saw the anniversary. They had a big anniversary this last quarter, and you saw that the menu changes they made there helped Sullivan's in terms of its same-store sales. So Del Frisco's bucking the trend of weak restaurant traffic and just an over-restauranted United States. Still a lot of growth opportunity ahead of it. Average PE over the last 5 years of about 20 times, which is relatively rich, but they do have a lot of growth opportunity. I encourage you to go out and field test one of the restaurants, especially if someone else is paying. And until then, we'll see you next time on the Investing Podcast. Thank you.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.